Hello, everybody, and welcome to the 2022 halftime report. You're in for a treat this evening. We're going to be going through what's gone on in the markets during the first half of the year, some of the economic data that we're looking at and seeing, and we're also going to make some projections about where we see things going. I'm sure you're all very interested. So sit back, relax, and let's work through tonight's presentation. As we get going here, I want to just start with some important disclosures. Triumph Capital Management is an independent firm with securities offered through Triumph Capital Management. We're a registered investment advisor, fiduciary firm. The information that I'm going to share with you this evening is really for educational purposes only. Some of the information that I share with you, if you are a client of Triumph Capital Management, make sure that you discuss anything that you deem from this presentation with your advisor. If you're not a current client of Triumph Capital Management, you should seek professional guidance and based upon your personal financial goals and your personal information and everything else. The information that I'm going to share with you tonight can change. I'll make some comments of that as we go through tonight's presentation, and nothing in here should be constituted as a solicitation to buy or sell any security. Anyhow, let's get into some stuff. The first thing about myself, my name is Derek Eichenwald. I have the pleasure to serve as the CEO and Senior Investment Executive of Triumph Capital Management. Enough about me. Let's talk about tonight's agenda. We'll talk about the market and sectors. We'll talk about the performance over the first half of the year. We'll dive into the U.S. stock market and bond markets, the international markets, the different U.S. sectors. I'll give you guys a little perspective on the markets of what's going on. We'll talk about why markets are selling off and the Federal Reserve, where the federal funds rate is, why is the Fed raising interest rates. We'll get into inflation. We'll talk a little bit about energy and commodities. I'll share with you some very eye-opening information, and we'll also talk about some positive economic activity, including PMI, labor markets, and we'll talk a little bit about a recession. So let's jump into it. So first thing on the docket, the markets and sectors. As most of you have probably read in the paper, we are off to the worst start of the year in the stock market since 1962. As of June 30th, the NASDAQ was down 30% for the year, the Russell down 24%, the S&P 500 down 20%, and the Dow Jones Industrial down 15%. Here's a snapshot of the S&P 500 over the first 6 months of the year. And what you'll notice inside of here is right away in January, we fell by, pretty substantially from S&P 500, 4,800, all the way down to S&P 500, 4,300. Kind of had held steady for a few months, had a little bit of a bull run, and then in April into May and continuing into June, we had this major market sell-off. Why such a big sell-off, coming here? We started the year with a pretty big sell-off, went flat, and then a big kind of drop. And of course, we'll talk about that as we unpack the information for you this evening. The U.S. markets, again, as I mentioned earlier, the NASDAQ, the Russell, the S&P 500, and the Dow, here were their performance at the turn, all the information I already said. The safe haven, where people typically go to hide out from the markets, the U.S. bond market. If you look at the U.S. bond market, investment grade bonds at the turn of the year down 16.33%. Junk bonds, which are riskier than investment grade bonds, down 13%, kind of strange there. U.S. Treasuries down 10%. Treasury inflation protected securities, interestingly, down 9%. Why interestingly? Treasury inflation protected securities are an instrument as a hedge to inflation. So if we have inflation going up, you would expect TIPS to be performing positively, but as you can see here, down, at the turn 9%. Municipal bonds down 8.2. So there is no great safe haven, right now inside of the bond markets. If we go across, before we go on Bitcoin, some people say, hey, what about Bitcoin? Um, at the turn, down 60% for the year. If we jump across the pond and look at international markets, and we start with developed, this is going to be mainly Europe, down about 20%. Emerging markets, China, Taiwan, India, Korea, Brazil, down 17.2. If we look at frontier countries, people are like, what in the world is frontier? So for years, we've been calling, different markets around the world emerging markets. Well, how long are China, Taiwan, India, Korea, and Brazil going to be considered emerging markets? They still fall into that category, but there's a new category out there called frontier. And frontier includes Vietnam, Nigeria, Colombia, Morocco, these newer emerging markets. You can see inside of here, no safe haven across the pond. You see Russia's blank because Russia's stock market is closed. You see Brazil actually up at the turn 2.15%. Brazil's economy runs on a lot of oil and gas companies as well as food production companies, which is one of the reasons why their market was or is hanging in there a little bit. Let's keep working here. If we flip the page and we dive into the sectors, these are the sectors that make up the S&P 500. Underneath those sectors, you have the different weights. So I've made comment to this in the past. People think the S&P 500 is equally weighted. It is not. Technology companies represent 30% basically of the S&P 500. Communications represent another basically 10%. So about 40% of the S&P 500 is in things we would consider tech. What I want to show you here is consumer discretionary. What is consumer discretionary? Consumer discretionary is just the things you buy with your discretionary dollars. You went to work, you got a paycheck, you paid all your bills, you have some discretionary dollars left over, and that's where consumer discretionary falls in. You'll notice this consumer discretionary was hurt the worst, down 32%. Communications and technology, stuff that falls into the communication area is what you would expect, AT&T, Verizon, but what also falls in there is Google, Facebook, so on and so forth. Whereas technology companies are going to be more of your, you would think Google and Facebook, but the technology area is going to be more harder assets such as Apple, right? They make devices, or what am I looking for? Nvidia making disk drives and that type of thing. You can see technology and communications very badly hurt, followed by real estate, financials, industrials, materials, healthcare. Consumer staples, not to be confused with consumer discretionary, are those things that we need to buy: toilet paper, bleach, that type of thing. Still down, but not nearly as much as the rest of the market. Utilities basically flat at the turn, and obviously, as you can all imagine, energy up a whopping 31.54%. The thing is energy only represents 4% of the S&P 500. Starting at the beginning of the year, energy basically only represented 2% of the S&P 500, but of course, with all these other sectors down and energy up so much, it represents a little bit more. But those are the sectors. I'm giving you all this information because we're going to start to make some points and start to unpack that stuff. Thought it'd also be interesting to look at the mutual fund index. So Investment Business Daily, which is a newspaper, they have an Investment Business Daily Growth Mutual Fund Index. And this is showing you what these particular large mutual funds have done for the first half of the year. On average, what you're looking at here, if you average all of these big losses out, the average mutual fund is down 28% for the first 6 months of 2022. And there's there's tons of other funds that are doing much worse than that. But obviously, you notice here big losses at the major growth mutual funds. Okay. Let me give you some perspective. All of that sounds very nasty, but let's look at some perspective on this. Many of you who have joined the call tonight, um, you've seen some of these charts before. Of course, they're all updated. One thing that I should have said at the beginning, in the housekeeping comments or in the disclosure comments, tomorrow you will all receive this video recording of this presentation. You will receive it in email. It'll come to you. The system automatically sends it. It says it takes 24 hours, so around 7 p.m. tomorrow night. However, we find that the system is usually a little bit quicker than that. I'll also say if you would like the slides of tonight's meeting, please email us and we will send you these slides. Okay, so a little bit of perspective. I love this chart. I've shown you all this chart many times before, but what this is this is the S&P 500 returns from 1980 until current date. The gray bars to the top are showing you what the S&P 500 did in any particular year. In other words, in 1980, the S&P 500 was up 26%, okay? The gray bars to the downside are obviously showing you what the S&P 500 did in any one year. So in 1981, the S&P 500 was down 10%. The red dots is where I want you to focus your attention. The red dots are showing you at for any particular year, at one point, what the lowest was on the market. In other words, in 1980, just to be easy on the eye and pick one out that's kind of obvious, yes, the S&P 500 did a positive 26%. However, at one point during 1980, the S&P 500 was down 17%. Even in the gray bars that are to the downside, you notice, for instance, we'll use 2009 global financial crisis, right? S&P 500 down 38% to close the year. But as most of you know, at one point we were down 49%, almost 50% on the S&P 500. On those red dots, what I would like to say about it is every single year on this graph, there is a red dot. There is not one year that does not have a red dot. So being down intra-year is the norm. It is not the exception, without a doubt. Over the last 42 years, not the exception. It is absolutely the norm. That's the first thing I want to point out. The next thing I'd like to point out is when you have a down market. So here's 1981, down 10%, 1 year. Here is 1990, down 7%, simply 1 year. 1 year. This was 2008. Think about that. That was the most recent huge hit in the market, before this year or before COVID. But think about what was going on in 2008, 2009, right? You had the Dow Jones Industrial go from 14,000 basically all the way down to 7,000, a 50% loss. You had what looked like every major financial institution going out of business, needing a bailout from the government, so on and so forth. And then all the other things I can say, car companies, insurance companies, so on and so forth. S&P 500 was only down for 1 year. The very next year up 23%, so on and so forth. What's probably catching your eye as I say that is these 3 consecutive years of down years. Well, remember, this was after 1999. I was just starting my career in this business, and I remember, learning some of the fundamentals that I'll share with you this evening. And people saying to me, hey, it's a new economy, .coms, and we had PE ratios, which we'll unpack as we open up tonight's meeting, that were in the 300s, right? And so there was this big unwinding that happened, and you did have 3 consecutive years that were down. But if you do the math inside of here, since 1980, the S&P 500 up 76% of the time. And so, that's a pretty good percentage of being up and up pretty well. If we move on to the bond market, and I show you this exact same chart, but I show you the Barclays aggregate bond index. So earlier I showed you investment grade bonds, high yield bonds, municipal bonds, and TIPS. What the Bloomberg, sorry, it used to be called Barclays, but now it's called, then it went to Bloomberg Barclays US Aggregate Bond Index, and now just referred to as the Bloomberg Aggregate Bond Index. This is the exact same chart. You notice here, this is showing you what the index has done since 1976. Interestingly enough, no different than the stock chart, you see those red dots. At one point during the year, bond indexes were also down. Obviously, you see this year, 2022 being, since 1976, the worst, year for bonds, okay? But with that said, same type of information that I shared with you for stocks. So one thing that we looked at is I was interested in going back and saying, hey, if we go back, okay, to 1930, all right, I want to know every single year in the S&P 500 what the returns were for the first 6 months and the next 6 months. And then from there, I want to filter out and I want to say, hey, I just want to focus on for the first 6 months of the years that we were down more than 15%. And then I want to know the rate of return for the next 6 months thereafter. So again, what we did was we looked at from 1930 until 2021. We looked at every single year in the S&P 500 for the first half of the year were we down more than 15%. What we found was there was only 5 years since 1930 that we've been down more than 15% for the first 6 months of the year. And then we were interested in what did the next 6 months hold? So 1932, first 6 months of the year, we were down 45%. That was January to June. But from June until December, we had a raging 56% rate of return. And you see those years going there. And then you see 2022, right? S&P at one point down 20%. We don't know what the next 6 months will hold. We'll make some projections about that. You take these numbers and you average everything out. Again, first half decline, rest of the year. It comes out, if you average all that out, that you've seen a gain of 24% for the 6 months following a bad market. I love this graph. Probably what I'm saying to you guys, some of you are laughing and that type of thing. I love this graph. This graph is truly fantastic. So what this is the Consumer Confidence Index. And then it's saying to us, what did the S&P 500 do for the 12 months after the reading came out? So the first thing is, what is the Consumer Confidence Index? Well, what happens is the University of Michigan every single month goes out there and they interview 5,000 households, okay? And they ask them a series of questions, and the questions that they ask them are pretty bland. For instance, here's an example of 2 questions. Say your phone rang and it was the University of Michigan for the Consumer Confidence Index report. Question they may ask you is, hello, Mr. and Mrs. Jones. We are interested in how you're getting along financially these days. Would you say that you and your family living there are better off or worse off financially than you were a year ago? That's an example of one question, and the people give an answer. They say, hey, another question example would be, looking ahead, do you think that a year from now, you and your family will be better off financially or worse off financially, or just about the same? And what happens is they come up with these readings. They've been doing this since 1971, and the average reading, if you notice here on that blue line, is an 85.6. What we wanted to look at is we wanted to know, okay, let's go and let's put this blue dot on all the peaks and all the valleys, okay? So low consumer confidence readings and high consumer confidence readings. Then we wanted to know what was the rate of return of the S&P 500 for the next 12 months. So in other words, August 1972, you had a consumer confidence reading that was pretty darn high, right? Like a 95, well above the average. From August of 1972 to August of 1973, right, the S&P 500 was down negative 6.2. It's kind of weird, right? People felt real confident. They gave all great answers. But check this out with me. Look at all of these high readings. Look at what the S&P 500 did, positive 1.2, positive 13, not bad. One of the highest readings we ever had, January of 2000, right before we had a recession. That was the dot-com bust, right? It kind of started to unwind as we got into 2000. S&P 500 negative 2%. And you notice these numbers +4, negative 4.2, negative 2.7. February we had a high reading, great market return. February of 2000. That was as COVID was unfolding, and COVID was very short-lived. But here's the really interesting thing. When the consumer confidence index went out there and they got these really low readings, okay, we feel awful, we're tightening our belt, we're not going to be spending money, I'm not going to be financially better off a year from now. What was the S&P 500's rate of return for the 12 months after that? So again, February 1975 to February 1976, S&P 500 did a positive 22%, positive 20, positive 29, positive 32, positive 14, positive 22, positive 15, positive 43. Our latest CCI number came in at 50.2, the lowest it's ever been in the history of the Consumer Confidence Index. I don't know what the S&P 500 obviously will do from June of 2022 to June of 2023. I just find this chart so interesting because the average person out there gets it wrong. When I say gets it wrong, you can see that the proof is in the pudding. Here's the real data. And there's more to that. We'll unpack some more of that as we continue to work here tonight. I was having this discussion with somebody. I threw this slide in right before the meeting, and I just wanted to point out time is on your side. And so when I say time is on your side, if we go back and we look at the S&P 500 and I say, hey, you know what? You invested $100,000 into the S&P 500 on July 1st of 2012, so 10 years ago. What was the value on June 30th of 2022? Remember, you have inside of there, these first 6 months of the year. Well, the value is 344 grand. Get an annualized return of 13.2. I will say this, you cannot invest directly in an index. It's impossible to do. These numbers come directly from the index's website, as does the chart. So taxes, fees, and that type of thing are not considered inside of here. But even after taxes and fees, it would be considered. It'd still be, a very good rate of return inside of the index. To be fair, I also went out there and I said, hey, let me look at, a 10-year period of time where things were kind of nasty. And so this is looking at July 1st of 2002. And this is a typo. Like I said, I just threw this in, so that should say 12. When you get these slides, if you want them, they will be updated. So again, this was just a 10-year period of time. As you can see, 2012, 2002, you invested the same $100,000 into the S&P. 10 short years later, that $100,000 still grew. You made about 78 grand. And it grew at roughly a 6% rate of return. So, time is on your side. The person I was talking to, it wasn't a client, it was another advisor here. He said, I was talking to so-and-so, she's 60 years old, freaking out about the market. And one thing I said to her is, hey, aren't we long-term investors here? Yeah, I understand you're 60, you're going to live to 100, you have 40 long years ahead of you. So that's always something to keep in mind. So why are markets selling off? Okay. When I ask this question and I think about this question, I get all kinds of answers. Oh, the government printed so much money during COVID. The Fed didn't raise interest rates quick enough. The Russian-Ukraine war, the administration's policy on energy, the U.S. printed so much money. The government's paying people to stay home and not work, et cetera, et cetera, et cetera, et cetera, et cetera. And if I could record every conversation that I have every day with every client, this list would go on and 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 on. The answer to this question is actually very simple. Everything that I just said, yeah, these things could all be helping in this one answer that I'm going to give you. But the answer why markets are selling off is because of inflation, and that's it. And if you disagree with me, I'll challenge you to call me and we'll discuss it, because any other argument you bring up, I would just reply to you, well, that's inflationary. And so what is inflation? And all of you know this, but inflation is just a decline of purchasing power. And so what you're seeing on the screen here is you're seeing a cup of coffee. In 1970, on average, a cup of coffee was 25 cents. And as you can see here today, 2022, the average cup of coffee, $1.85. And so if you think about it, let's say every day you buy a cup of coffee, but your income is exactly the same. Well, you're spending more and more on this cup of coffee, and it's just the cost of things going up. And so, what causes inflation? And so the root cause of inflation is money supply. When you have more money supply, okay, meaning a government, a central bank prints money, you have inflation that occurs. And you have inflation that can be broken down into three categories: demand pull, cost push, and built-in inflation. So what is demand pull? Okay. Demand pull inflation occurs when an increase in the supply of money and credit, right? If there's an increase of credit, stimulates the overall demand for goods and services in an economy. And when it increases too rapidly, as you notice here, it says, hey, sneakers, forget about being exclusive, right? What happens is there's all these people in line to buy these sneakers, and what does the place selling it do? They raise prices. Okay, so that's demand pull, just a lot of demand for whatever the particular thing is. But why does that demand pull happen? And that demand pull can happen if you inject cash. So you might say, from what I said earlier, I would challenge you on that question. Well, Derek, that happened because the government printed money. Yeah, but again, the why market's selling off is inflation. The government might print money, you might not have inflation that happens, right? We by the way, in 2008 and 9, in that global financial crisis, we injected a bunch of cash into the economy and no inflation happened. Right. So again, markets are selling off because of inflation. There's reasons for inflation, but again, causes inflation. Cost push. And so cost push, as you can see here, it says balloons $5 and now $10. But you can see the guy selling the balloons, you don't see it, but his cost underneath the balloons, being helium, doubled on him. So he doubled the price of the balloons. And so we're going to unpack what's going on with commodities. I'm going to show you some really interesting data. I think you'll really enjoy it. And then you have built-in inflation. And built-in inflation is just kind of the slow inflation that happens. It's kind of related to psychology in a way. And what I mean by psychology is, as prices slowly go up in a normal type of environment, people expect their wages to go up to keep up with that inflation. So there is some built-in inflation inside of there, so on and so forth. And so if I go back and I look at from April of 2018 to June of 2022, what you'll notice on this side of my graph, I have these inflation numbers. And you'll notice that inflation very tame, all through, 18, 19, and then all of a sudden we have this runaway inflation. We got the new CPI print, came out this morning at 6:30 a.m. Mountain Standard Time, 8:30 a.m. Eastern Standard Time. And on the new inflation, year over year inflation, June 2021 to June 2022, inflation came in, and I'll show you more about this on the next slide, at 9.1%. It was kind of crazy. Before markets opened up today, futures were up about 250, meaning the market was going to raise 250. The second CPI number came out, markets went down 250, meaning the market was going to open up down 250. Markets did open up about 250 down. We then, the markets fought that all day long. Very interesting. At one point, we were flat or slightly positive on the market, and the Dow closed today down 200. But today was actually not a bad day. And why did markets fight this so much? Well, today was kind of a test of that, and it kind of goes to this presentation. And I'll tell you why. And so if we keep working here, as I said, this was May's last reading, 8.5. And then, of course, as I just mentioned, we had inflation tick back up. Now, this inflation issue is not just going on here in the United States of America. As most of you know, if we go, all across the world. So if you look at all global economies, we have average inflation at 7%. DM stands for developed markets. That's going to be Europe, the US, so on and so forth. A bit higher than what we got globally. That's 7.6. And you can let your eye kind of study this chart. You can see here in the US, I mean, that says 8.6 because the information just came out this morning. This next month we'll read 9.1. You can see in areas like China and Indonesia, you do not have bad inflation going on. These are obviously the emerging market type of countries. You can see Russia, as you can imagine. I don't even, it says 17%, but who knows, about that data. But inflation around the globe, okay? And what you're reading in the news is you're reading, hey, central banks around the globe are raising interest rates, and so what does that all mean? We'll continue to unpack it. But the question that I asked earlier is why are markets selling off, or the question that I'm trying to answer is why are markets selling off? And I said inflation, okay? And so I wanted to unpack inflation a little bit, but let's just talk about something, right? Like, okay, Derek, I get it, inflation, but why are companies selling off? Well, the question is how are companies valued? And this is how companies are valued, okay? That is it. What does that mean? So this is just simply a discounted cash flow model. The DCF is obviously discounted cash flow model. CF1 is the cash flow period. R stands for interest rate, and N is the time. This is the equation that you use to determine the value of a company. So let me put that in English for you. Most of you have heard me say this many times. I'm going to again use my ice cream store example. So you and I own an ice cream store. We've owned it for the last 30 years. Our ice cream store makes $1 million a year. From that $1 million that we make, we pay our employees, we pay, for our product, our cream, our sugar, we pay, our rent, these types of things. And at the end of the day, after we pay all of our expenses, we are left with $100,000 of revenue. If we went to go sell this ice cream store, okay, what we would typically get for it is a privately held business, so a non-public company. We would typically get 3 to 5 times its value. What does that mean? That means that somebody would write us a check for 300 to 500 grand, 3 to 5 times our revenue, for the right to ring the register for the next 30 years, okay? Now, I think this ice cream store example gives us a little something extra to talk about. What is ice cream? Maybe for some of us, it's a consumer staple, right? But for most of us, it is, just to switch the slide for a second, it's consumer discretionary. If you think about your average American out there today, right? Prices at the pump have gone up. You have these inflationary pressures. They've seen values of their 401k or their investment accounts go down. And what do they say? They say, hey, we're not going to take the kids out for ice cream tonight. Okay, ice cream is certainly consumer discretionary. And so if you think about it, how are companies valued? Remember I said, hey, we make $1 million and we're left with 100 grand in revenue, right? Basically at the end of the year. Well, we have this big line outside of our door, but all of a sudden that line dries up, right? Or that line gets cut in half. Well, heck, instead of us now, making that 100 grand, maybe we only made 50 grand. And again, what's the value of our business if we only made 50 grand? Again, 3 times 5. You see where I'm going with that? Well, now ask yourself this, or understand this. I understand the ice cream analogy, Derek, okay? I understand. So now just think about this. What's every company essentially doing that trades on the New York Stock Exchange? They're selling a widget of some type. Are they selling ice cream, or are they selling, a computer chip, or whatever the case may be, but they're selling a widget of some type. Those companies that are in the consumer discretionary all the way down to energy and every place in between, well, think about it. Is their line shrinking? And if their line is shrinking, they don't have as much revenue coming in, and therefore their share price goes down because the company's not worth as much, right? That makes sense. And so again, those inflationary pressures, because money is disappearing elsewhere, it's no wonder why consumer discretionary is the worst performer, if you catch my drift. And let's keep working here. Um, Sorry about that. I'll let that spin. But is inflation bad, right? Is inflation bad? Well, inflation always needs to be looked at next to wage growth, okay? And what I mean by next to wage growth is, think about it. You have somebody last year in 2021 who earned $100,000, okay? For them to buy the same amount of goods and services today, they have to be making $109,000, right? If they're making $109,000, inflation isn't really a problem, assuming they keep up with inflation, because they would be expected to buy the same amount of goods and services or the same amount of widgets. And so where's wage growth? So wage growth is shown to you on the blue line, okay, right there. Wage growth year over year, so from June of 2021 to June of 2022, is 6.4%. By the way, that is a astonishingly high wage growth number. Our average is 4%, our 50-year average. A 6.4% wage growth number is fantastic. However, 9.1 in inflation. So think about it. I mean, if you had the complete reverse happen, wage growth at 6.4 and inflation, let's say at 2, all of a sudden that consumer's got more money in their pocket to buy more widgets, right? And in this case, you have the reverse happening, okay? We're going to keep unpacking stuff here. So if you do the math on it, you have inflation year over year at 9.1, you have wage growth at 6.4, so the consumer's taking a 2.7% cut in pay. That's just in pay, right? And so they're not expected to buy as many widgets, and therefore companies sell off. When you look at the labor market, it is amazing what's going on, okay, amazing. What I mean by this is, first of all, if you look at the amount of job openings, right now today, for every unemployed person, there's 2 job openings. Okay, there's 2 job openings. In fact, there's about 5.5 million more job openings than there are unemployed people. Now, think about that for a second. That's one thing that's driving that wage growth, right? Places are, I think I maybe even said this, I was on the phone with a long lost cousin of mine who owns a cleaning company out in, where is he, like Indiana, cleans office buildings. He has people that do it. And he said, Derek, I have a core of people on my team, and then I had, like high school kids or teachers, who would get out of school early and they might work 1 or 2 days a week and come clean a building. And he's like, I was paying them $15 an hour. He's like, I can't compete today. McDonald's and these places are giving these guys signing bonuses. Okay, so that's how much labor demand is out there. At the same time, if you look at it, the amount of layoffs that we have in the US today is at a 22-year low. Companies obviously need workers. You see layoffs very, very low. And then there's this particular chart that shows you something very interesting, and it says quits, people quitting their jobs. Well, people quitting their jobs is actually at a 22-year high. Wait a minute, Derek, that seems a little weird. Well, let me explain. It's not as if these people are quitting their job and not working. This is somebody, let's say it's an engineer at Chevron. And they get a call from a headhunter, and the headhunter says, hey, at Chevron, you're making 200 grand a year. Exxon wants to hire you, and they'll pay you 250. And so this person quits their job, okay, and goes over to ExxonMobil. And that's another thing that's leading to that wage growth, okay? Our unemployment rate, if I were to go back to our last slide, okay, our unemployment rate is, sorry, let me get rid of that blue box. So our unemployment rate right now today is 3.6, okay? As you can see here, unemployment rate on average over a 50-year period of time, 6.2. Today, we're all the way down to 3.6. This is good news. And so I had somebody ask me, they were like, well, Derek, if our unemployment rate's so good, isn't that inflationary? And the answer to that question is yes, that is inflationary. You have more people working, they demand more goods and products, they tend to spend more money, they have more money in their pocket, and that tends to cause some of that inflationary pressure. But it's good inflation, right? It's because you have such a strong labor market. And what you're reading today, and this is kind of new news, not new news, I've been seeing it for the past month or so. Hey, this company or that company is no longer hiring. Okay, maybe they did a little bit of over hiring. Well, you saw an announcement from Twitter come out. Well, obviously Twitter's up for sale, so that's going to come from Twitter. But you saw Facebook announce like they were going to hire, I don't know, 5,000 recent college grads. They put that on hold. That is okay, because here's why. Remember how I said that inflation is good when you have such a strong labor number? The right amount of labor is an unemployment rate at about 4%. Now, when I say the right amount of labor is about 4%, unemployment rate at 4%, that's the Federal Reserve. According to the Federal Reserve, that's the right amount of unemployment. It makes wage growth, not so hot, and it keeps inflation in check. So the question is, will inflation cool? And these slides I really want you to pay attention to because this data is brand spanking new for this month, and it's kind of crazy. So if you look at inflation, okay, what are the components of inflation? Energy, okay, new and used vehicles, food, restaurants and transportation, and shelter, okay. So check this out with me. Let me show you some stuff. Let's focus on energy for a second. Really kind of interesting. Some interesting information here first. First of all, production of barrels of oil. So 2022 or 2021, you can see how much the U.S. produces. So right now, today, the U.S. produces about 20 million barrels of oil per day. If you look below that, that's OPEC. OPEC produces about 34 million barrels of oil per day. Russia producing about 10 million barrels of oil today. Therefore, globally, 100 million barrels of oil are produced every single year, okay? Consumption. If you look at consumption of oil, the U.S. consumes about 20% of that oil production. China consumes about 15%. The rest of the globe gobs up the rest of it, and every day 100 million barrels are produced, and every day 100 million barrels of oil are drank, okay, by the global economy. If you look at the price of oil on July 12th, oil closed at $95 a barrel. You've all heard me say that probably the fair price of oil is someplace between 80 and 100, okay? You'll notice on this chart, yes, this was 2022. We did spike a little bit above 120 this year. But here's the interesting, here's some interesting facts. We opened 2022 with oil at $76 a barrel, as you can see on my screen. Come March 31st of 2022, oil had gone all the way up to $100 a barrel. That is a 32% increase in oil just in the first 3 months, okay? Oil today, now this isn't oil today, this is oil yesterday because, today just happened. But oil today is now down to 95. If you look at it from March 31st until today, okay, we've had a 4.4% decrease. Now, when I say that to you, you might scratch your head and go, well, then how come the reading for June was so high if prices of oil have been coming down? Well, remember what I just said. This news is all new. If you look at my next chart here, and I asked the question again, will inflation cool? These were oil prices, okay, all through June. Now look, we started June at oil 115 a barrel. But look here, oil was really heavy and hot, all throughout the middle part of the month, right? We had oil at 120, 122. We started to cool as we got to the end of June. So these high numbers were in that June inflationary number for sure. Now we started to cool. And for anybody who I talked to as we went through June, I was saying to you, hey, look, we want to see, oil kind of get below 100. We think it'll start to go there. And by the way, even on the last slide where I showed you, hey, this was, March till today. And then I'm showing you, look, June, okay, yeah, we started at 115. We ended the month at 106. We were down in June, 7.55, but you have all these high numbers in June. Look at this with me for a second. This was the month of May. Completely the opposite happened. In the month of May, we had, oil prices start at 105. We went up, to these high prices, as you can see, in the middle of the month. We ended the month at 114, a 10% spike just in May. I bring that up only because it's not like since March we've been falling, but as I mentioned earlier, right, as we got into those late parts of June, we started to see oil taper, okay, and we continue to see oil taper. Today yesterday we closed at 95. I don't know what we closed at today, but I think it was 96. But I'm fine with that. If you think about it, oil closed at 100 on March 31st. Yeah, between March and today, we kind of percolated up. But if you think about that inflation number, let's just say we get that average price of oil to just kind of hang around the 100, 96, 103, but we hang around the 100 over the next 3 months. Well, that's going to have a zero inflationary pressure on that CPI number. Okay, no inflation if we get that. Now, I don't know where oil goes. I'm just reporting the news here, right? Hopefully that happens, okay? Prices at the pump. So today's average around the globe, 4.6. You can see the red states shown here, all the states in red. You can see what their national retail prices are. You can see, the states that have the cheapest gas are obviously down in here, are larger oil producing states, so on and so forth. But obviously, the one thing about the price at the pump is it reminds you every day, oh my God, the price of oil, is at, $5 a gallon. And if you look at it, if you go back a year ago, the average price at the pump was $3.15. Again, today, if you look nationally, the average price at the pump is $4.63. By the way, that's come down. For those of you who are always watching gas, last week this was more like $4.73. But you see a 47% increase in the national average from 1 year ago. Okay, and Americans notice that a big billboard on every single corner of every major street shows this to them day after day. Hey, Derek, why if oil is up 33%, at the quarter, and then basically down 5%, so really only up about 28% for the year, why is WTI, meaning a barrel of oil, only up 28, but the prices at the pump are up 47? You hear politicians talk about this and politicize it a little bit. Hey, oil's coming down, but we haven't seen it at the pump, because that's a barrel of oil. Okay, that's a barrel of oil. That barrel of oil still needs to be refined. It still needs to be delivered. It still needs to be stored at the gas station. It still needs to go into your pump. A gas attendant, the guy working there, the gal working there needs to get paid. Blah 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 blah. Some of you might say, yeah, but didn't they do something with the tax? And so maybe that's why some of the reasons it's coming down. Maybe a little bit, but not a lot. There's a reason why it's coming down, and I'm going to show you that reason right now. So this is super interesting, okay? Building supplies and food. Let's take a look at metals. So silver, gold, copper, steel, and aluminum. These are where these are year to date. Wait a minute, Derek, you put a minus in front of them. They're not down. Those things are doing great. Yeah, you might believe so. Why? Because silver, at one point, not too many moons ago, so by the end of March, silver was up 13% for the year. In other words, you invested 100 grand January 1st inside of silver. The end of March, it was basically worth $113,000. Okay, and that even hung in there until about June. Today, however, that 100 grand that you invested, that matriculated all the way up to about 113,000. Today, inside of that silver, today it's only worth about 80,000. Why? Look what's happened to these areas, right? over the last 1 month. Look at these returns over the last 1 month. You have metals, building supplies tanking like crazy over the last month and over the last 3 months, right? It's kind of been happening, but over the last month, a big downturn. And think about this. Silver and gold, let's kind of take out of the equation for a second, because silver and gold, yeah, they're used in building materials, right? But they're also used as, maybe a safe haven, jewelry. There's other things for them. Look at copper, steel, and aluminum, basically exclusive type of building materials, okay? And look at where they are year to date, and look at what they've done over the last month to 3 months. I mean, the crazy thing is, no different than silver and gold, copper. Had you put 100 grand in copper January 1st, okay? Copper at one point was up 10% for the year. Okay, it was up 10%. You notice here, year to date, down 25%. And that being up 10% lasted until about mid-June, just about the same time those gasoline prices started coming down. Okay. And had you had that 100 grand inside of copper mid-June, you go, oh my God, I'm up 10%. The markets are down 20. My 100 grand's worth 110. And all of a sudden, over the last, couple of months, now that 110 grand that you had for the year down 25. So like now it's only worth 75. Same thing with steel. I won't keep giving you the math on it, but I think you catch my drift. And so think about this stuff for a minute. Well, wait a minute, Derek, that's so weird. I didn't know this. Yeah, this has happened fast and furious, right? This has happened fast and furious. But think about this stuff for a minute. Inflationary things, right? Back to that inflation, the cause of inflation, supply inflation, so on and so forth. The prices of these things are coming way, way, way down. Some of you remember last year, lumber, right? I don't have lumber on here today. But lumber was one of the first things that came way, way down. So there's some stuff inside of here that is applicable to the supply chain. Canada produces a ton of lumber. And when Canada was basically shut down and no lumber was coming into the United States, you had lumber prices go up something like 48%, right? But Canada has opened back up their markets and you've seen lumber come down. Earlier in the presentation, I said to you, hey, look, markets kind of slid in January. We were flat. And then April, we had a complete cliff that we went off, if you remember. Why in April did we have this complete cliff that we went off, right? Well, it wasn't that we had so much new data. It was that China announced, hey, we're closing 45 cities, COVID restriction. We're closing 45 cities. And in China, when they have a COVID restriction, it isn't like a US COVID restriction, right? They're screw driving people into their apartments. They can't leave. You can't go to work, right? They got fences around apartment buildings out there. Well, think about that. China's a huge supplier to the rest of the world. They're a huge supplier of the supply chain. Okay. If you lock down China and that happened in April. And so when that happened in April, right, and they locked them down for 6 weeks, markets slid off. Why? Because expected more inflation. China's now opened back up, and when China opened back up, you started to see a big slide in these commodity prices, okay? You started to see a big slide in these commodity prices. All right, so will inflation cool? Food. You notice the same type of things in food. You're starting to see food come down. So you see soybeans, right? When I say 1 month, that's the last 30 days. The last 3 months, that's the last 90 days. These numbers are all as of the close of business today. Look at wheat, right? Look at wheat. Wheat was up huge for the year, especially with Ukraine, right? Ukraine, you probably read it in the newspaper. Hey, Ukraine's a breadbasket for the rest of Europe. Wheat was up something like 30 some odd percent, coming into May and June. If you look at cotton, this is kind of crazy. Cotton was one of the best performers. Cotton was up cotton was up something like what were we up? Cotton was up something like 40% going into May and June. And now we're down 15% for the year. But look, all of that kind of happened over the last 30 days. So, the reason why I'm showing you all this, and I know these slides are a little boring, I'm showing you all this because I'm asking you the question, will inflation cool, right? And so you're like, well, what's this have to do with it, right? Food is a big one, okay? Soybeans are still up 18% for the year, but still a pretty big fall off, okay, over the last month or so. Soybeans, by the way, as late as the middle of June, we're up 32% for the year. So, now only up 18. Still been doing well, but huge cut over the last few months. Okay. So, is inflation in food calming, or is it cooling? So again, will inflation cool? The Fed. So listen, the current federal funds rate's 1.75. What is the federal funds rate? It's the rate that the Federal Reserve lends to member banks. So in other words, Wells Fargo gets to go to the Federal Reserve and they get to borrow money at 1.75. Wells Fargo then turns around and lends that money to you at something north of 1.75, and Wells Fargo makes the difference. Okay. Our federal funds rate going into the year 2022, so the year 2000 was 1.75. If you remember back in 2000, people were like, hey, this is the lowest interest rates are ever going to be. The federal funds rate's so low, blah, 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 blah. And then we went into COVID. And in COVID, in March of 2000, they cut the federal funds rate by 50 basis points beginning of March, bringing the federal funds rate down to 1.25. End of March, they made an emergency cut of an entire 1% that brought the federal funds rate down to 0.25. That was COVID. Okay. The Fed, with their rising interest rate policy, has simply brought us right back to where we were prior to March of 2020, prior to COVID. Still amazing, lowest, with the exception of COVID, the lowest really we've ever had in the country. July 27th, we get the announcement by the Fed what they'll do with interest rates. And this morning, when I said to you, all of a sudden, when this inflation number came out and futures were positive 250 and then went to negative 250, that's a drop of 500. All of a sudden, I started looking at, okay, what's the chances of them raising 75 bips or even 1% completely, therefore bringing the federal funds rate up by these numbers. And these percentages started to get pretty high. In fact, in the morning before markets open, it said, hey, now with the with inflation at 9.1, there was a 30% chance that the market, that the Fed would raise by 1%, bringing us all the way up to 2.75. Markets sold off. They fought back. Why did they fight back? My belief is when you started to unpack this data, when you started to look at where commodities are, as I just showed you, when you started to look at, hey, what's really happening with oil, when you started to look at new and used vehicles, yeah, they're up pretty darn good year over year, but over the last 2 months, down about 4.1%, right? All these inflationary factors are cooling. And so remember, your CPI number is always backwards looking, okay? And so, it's expected that they'll raise 50 basis points, okay, inside of there. And look, why does the Fed raise rates? When the Fed raises rates, it cools inflation. Why? It makes money more expensive for people to borrow. That's one. And you're starting to see some of the effects of the Fed's recent interest rate hikes, right? Personal spending, May to May, the new number for June, the number for June comes out later in July, so my most recent's May. It is expected to be 0.80. It was only 0.20. So in other words, the consumer's not spending as much, right? You think about conversations maybe you're having with your neighbor and that type of thing, and so that is also why those commodities are coming down, metals, food, so on and so forth, right? People aren't demanding it as much, prices come down. Okay, think about this for a minute. A year ago, June of 2021, rates in the United States of America on average for a 30-year mortgage were 2.87%. Today, rates, it's a little lower than this. It's like 5.71, but a day or two ago, it was at 6%. Rates today are at 6%, a huge uptick. Kind of crazy if you think about that, because remember I said, banks get to go out there and borrow at 1.75. They're turning around and lending at 6. Even though the federal funds rate's 1.75, banks' effective rates right now and what they borrowed from the Fed are lower than 1.75. Why? Because they borrowed a ton of money when the Fed was lending them money at 0.25. okay? And so is inflation cooling, right? Think about what this has done to the consumer out there. It's one of the reasons why cotton is down and all of those commodities are down. You're a first-time home buyer. You've been out there shopping for a house for 3 months or whatever the case may be. Rates have been going up behind you. All of a sudden, you were going to buy a house and your mortgage payment was supposed to be 3 grand a month. And 2 months later, they're telling you, hey, it's 4 grand a month. You go, hey, maybe I'm still in the market for a house, but that house I was going to buy, I can't afford it anymore. So I got to start shopping again for a new house. Think of the economic activity that occurs when somebody buys a house. Mortgage lender got paid, a realtor got paid. The person typically is going to buy new stuff for the house, furniture, towels, decorations, TVs, so on and so forth. When that doesn't happen, economic activity starts to cool. That is why the Fed's raising rates. Why are banks lending so high? Because they're greedy. I mean, maybe, but they're expecting the Fed to continue to raise, so they preemptively raise their rates. Okay. All right. Let me just tell you a quick story. I know we're getting toward the close of the hour. I don't have too many more slides, but I do want to fit this story in. I had a meeting with a client of mine. This client of mine works in the real estate industry. He's been a lender. He does lending, okay? He's been a client of mine for close to 17, 18 years. He came in a day or two ago, and I knew what the story was. And what he said to me is, he said, Derek, last year, I made $605,000. The year before that, I made $594,000. The year before that, he made something like close to $400,000. And basically, the 8 years prior to these 2 big years making 700 grand, he made himself about 350 to 400 grand a year. And so first thing is you might go, hey, how did he double, how did he go all the way up to 700? Well, obviously, when the Fed cut rates down to 0.25, like 100% of this guy's business was just doing refis, right? He's refinancing everybody's 30-year mortgage, right? And getting people, 2.6, 2.9, what have you, okay? So far this year, his income, so far this year, the first 6 months of this year, $38,000. $38,000, that's it. Why? Close to 100% of his business was refinances. He's not doing any refinances. He's doing a refinance today, right? Not doing a refinance today. New purchases. New purchases are still happening. The velocity of new purchases has certainly slowed down because of where rates have gone, okay? Obviously, for that client, good news is the guy, since he's been my client, has done nothing but save money. So he's got plenty of cash to, weather the storm. But my point being is, think about that. How many other mortgage lenders are in that same position? When does that start to matriculate down? And I'm not saying, hey, mortgage, anything like that. If you're a mortgage lender and you're on the call and you're doing great today, fine. But I'm saying, I'm just, talk to people. There's a gal who works across the street. She works at Chicago Title. I always ask her, hey, what's going on at business? Oh, she doesn't know why I'm asking. She doesn't know what I do. But she says to me this morning, I was talking to her, and she said to me, oh, things are slowing down. Yeah, we don't have as many deals. And I knew that's what she was going to say because of my appointment with my client the other day. Is any of this bad? What I'm saying is inflation going to cool, right? My guy who's only made 40 grand, so 38 grand so far this year, is he tightening his belt? Of course he is, right? Are other people in these other areas all around the economy tightening their belt? Yeah, but my question is, I'm not saying anything about that except for, will inflation cool? The Fed raises rates to cool inflation. Does that necessarily mean that markets need to do terrible? No. If you look at previous rate hiking cycles, these are all them listed on my chart here. This was the S&P 500 rate of return, 83 to 84, right? About a 12-month rate hiking cycle. Yeah, markets were down 9.6, but you can see there's other time periods where markets were up, right? And in fact, if you average all of these out, in a rising interest rate environment, the average return on the S&P not huge, but not too bad at a 5.8. Why does the Fed raise interest rates? The Fed raises interest rates to cool down the strength of the economy. So unemployment 3.6. Again, the Fed wants unemployment at 4. So some of these effects of what are going on, you heard Facebook, oh, we're not hiring the 5,000 kids. Twitter put hiring on freeze, etc. Is the net effect of this. It's what they want to have happen. They want unemployment at 4, okay? It's at 3.6. And they want inflation at 2. And so we're at 9.1, right? But they want inflation at 2. And so, and I'll come back and I'll make a conclusion on that again in a second here. Inflationary pressures. Listen, the supply chain is very difficult to. There's no economic indicators. We've been looking at things like Google Maps of how many ships are outside of China, how long they've been sitting there, what do our ports look like, but there's no economic report that comes out about the supply chain, okay? Commodity prices, as we talked about, can be very unpredictable. Listen, tomorrow the price per barrel of oil could go to 150, okay? But what I'm saying is they're cooling. Okay, they could go to 150, but at least today we're seeing that. And I said this to you at the end of the first quarter when I did this in April. Hey, we think we'll see oil prices come down, and we're starting to see it. We do not believe this is a 2008, a 2019, 99 for 2 reasons. Number one, 2008, right? You had unemployment shoot all the way up to close to 20%. You had companies going out of business. Look at Lehman Brothers, gone, right? Goldman Sachs, almost gone. Merrill Lynch, gone. Got bought by Bank of America. I know they're still around, but gone. The list goes on and on and on. AIG almost gone, right? Think of AG Edwards and firms and a bunch of medium-sized banks and so on and so forth, gone. You not see that today. You're seeing unemployment very, very strong. You see the consumer out there. Yeah, consumers are getting worried about things, but you're not seeing massive layoffs and these types of things. The supply chain, we're keeping an eye on it, but as I said before, the supply chain gets better every day, every week, every month, every quarter, every year. The supply chain fixes itself a little bit. Yeah, there might be a hiccup here and there, like China shutting down 45 cities. That's a big shutdown. Okay, but these things start to work themselves out. Will commodity prices come down? That was a question that I posed to anybody back in April. I laid out an argument as to why, and I'm happy to report that argument is happening. 1999, right? When we had, in 1999, and then that recession started about February of 2000. We had 3 years of a down market. Remember, you had PE ratios at 300. Okay. For those of you who aren't familiar with PE ratios, I'll tell you what that is right now. But I asked the question: are stocks expensive, right? Or do we have a bubble going on and that type of thing? And so earlier in the presentation, I talked about the ice cream store. And I talked about, hey, $1 million, we make 100 grand. We're going to sell for 3 to 5 times earnings. Somebody write us a check for 300 to 500 grand. If our ice cream store was publicly traded, okay, we would, on average, over the last 25 years, on average, we would actually fetch about $1.7 million for our ice cream store. What? Why, if it's publicly traded, would it be worth 1.7? But if it's privately held, it's only worth 300 to 500 grand. Well, it's about a 12% difference, and it's what's called the liquidity premium. And what is the liquidity premium? The liquidity premium is simply this. Let's say you own an ice cream store privately held, not publicly traded. And tonight or tomorrow in the newspaper comes out, ice cream causes cancer. Okay? So the line outside of your ice cream store dries up. There's nobody there. You can't quickly sell your ice cream store if it's privately held. If it's publicly traded, with the click of a button, you no longer own Haagen-Dazs. Okay? So publicly traded companies get a higher valuation for what liquidity? On average, companies get I'm just going to call it a 17. That's why I said if our ice cream store was publicly traded and we had 100 grand of revenue come in, our ice cream store would be worth 1.7 million. At the close of business on July 12th, PE ratios of the S&P 500 were at 15.9, below the 24 average of 16.8. And what I'm saying is, you always hear people say buy low, sell high. A PE ratio is a way to determine to buy low or sell high, right? If you thought about it, just think about if you were buying a company, okay? You'd probably want it for that ice cream store, play closer to the 300 than the 500, right? Okay. Economic activity, listen, economic activity can be followed by PMI. Basically, PMI is a survey. It's sent out to 400 companies in 19 primary industries. These 400 companies that it gets sent out to, they all get weighted by their contribution to GDP. PMI is based upon 5 major areas: new orders, inventory levels, production, supplier deliveries, and employment. When you, if you notice here, look at 2008, right? You see all this red, right? Global financial crisis, okay? You probably remember over here, you had some of that, some of the stuff in Europe going on, right? Some hiccups in Europe. By the way, that is COVID, okay? When you have a PMI above 50, it equals expansion. Below 50, it equals contraction. If you look globally, we have a very good PMI number at 53. If you look here in the United States, and these are all the latest reading, we have, a PMI number of 52. This means they're getting, it's very similar to that consumer confidence rate reading, but this is something that employers have to fill out because they want this information from them. It just kind of talks about the health. It's no wonder that this is all green, right? It's no wonder. Think about it. We have inflation today. Why do we have inflation? People demand and stuff, so on and so forth, okay? And so companies are going, yeah, we're hiring more people. That's a component of this number. Yeah, hey, listen, we got new orders, right? People put in orders. Did you all do your Amazon Prime shopping or whatever? Prime Day today, some Prime Day today, so on and so forth. Hey, our inventories are low. I never go into the store ever, but for whatever reason, I was like in Target a week or two ago. Oh no, I know where I was. I was out of town and I went to a Target because my suitcase broke. And I went into Target and it was like a quarter of the store was just empty, right? You may think, oh, that's awful. Yeah, it is awful for inflationary pressures, but for PMI, it's like, oh, you're not sitting on a ton of inventory. In other words, you're recycling it, you're selling it, so on and so forth. That's that's an economic activity, okay? Again, think about labor. Labor is what drives this stuff. Labor's hot, okay, right? You got more people working, more people spending. Recession. As far as recession is concerned, the first thing that I want to say to you all is that a recession is defined, or it was forever, still defined in Britain, as 2 quarters of negative economic activity. 2 quarters of negative economic activity, okay? Well, think about this. You got a quarter of Target closed in Boston, Massachusetts, unusual, right? Gazillion people. It's empty. Quarter of it's empty, empty shelves, okay? GDP is driven on consumption, people buying stuff. Inflationary pressures come from people buying stuff, right? Like the sneakers and the balloons or whatever I was saying to you. And so you would think since 70% of GDP is driven by inflation, you would have had negative GDP for the first quarter of 2022. First quarter of 2022, you guys may have read in the paper 1.8. That was the initial read. You get 3 more readings of GDP. They refine it. The final reading on Q1 was negative 1.6. That doesn't make any sense, does it? How could that be? I'll explain why in one quick second here. Okay. But remember, a recession is defined by 2 quarters of negative economic activity. Q2 comes out July 28th, the day after the CPI read. It comes out at 8:30 Eastern Standard Time, 6:30 Denver time. We get the Q2 GDP number. By the way, expectations are that our Q2 GDP number will just be slightly positive. I disagree with it. This is a consensus. I think that we will have a negative GDP for the second quarter. And I think that as you all open up your newspapers over that weekend and as we move into August, you will say, well, we are in recession. And please don't say that because although you technically may be right, think about this. We get Q2 GDP numbers July 28th. Q2, right, is for April, May, and June. It is a backwards looking number, okay? So what happens is, you ever hear this? People are like, oh, we're in recession. And then people are like, yeah, we've been in recession for 6 months. The person who says we've been in recession for 6 months is technically right? Because it's a backwards looking number. I'll explain to you why I said I think that we'll have a negative GDP, why we have this negative GDP. By the way, we're done. There's like one more slide. Um, so Q1, I was like, this is impossible. This makes no sense. It's like saying 2 + 2 doesn't equal 4. Somehow you go, hey, it equals 3, and you get convinced of it. It made no sense. So I read the entire GDP report, dug into it, unpacked it. I couldn't. I was like, this is a it was like a bad newsprint. So in the USA, we do not export a lot of stuff, as you know. We import a whole bunch of stuff. We don't export stuff. However, what we do export is big ticket items. We export a whole bunch of cars. We export a whole bunch of planes. And we export a whole bunch of high-end electronics. Okay. And when I dug into the GDP report for Q1, essentially, we didn't export anything, okay, in Q1 of 2022. So then I was like, well, why don't we export anything, right? Is like demand drying up that much? And I didn't know the answer to that because they don't tell, it's not like they tell you that in the report. You have to get to it. About a week went by and GM came out. GM came out and they said, we're shutting down our plant in Ohio. And I'm like, what's going on? You have all this demand for cars and all these people out there. Why would GM be shutting a plant, right? Typically, when they shut a plant, they're laying people off, right? You hear that in bad, nasty recessions. And GM then said, no, we're not shutting down the plant because we're laying people off or there's no demand. They said, the plant's filled with cars. They're already basically sold. We don't have the parts to put into the car to make final delivery. So we're sending everybody home for a month because China shut down until the supply chain fixes itself, so we can get the parts, put them in the cars, and deliver them to the consumer. Same thing with plant manufacturers. Same thing with higher end electronic components. That's what led to a negative GDP in Q1. Basically, our exports very, very. I mean, once I knew that, it was no longer bizarre. GM confirmed it. By the way, then Target and Walmart came out. Target and Walmart came out and they reported their Q1 earnings. And it was so crazy. They said, hey, listen, we scanned more SKUs at our register. We sold more stuff than we ever have in the history of our companies. Okay. However, we didn't have a whole bunch of our big ticket items like, large screen TVs or bigger end computers and that type of thing. And they make pretty good margins on those higher end electronics, right? What the Target I went into, 25% empty. I don't know what section of the store that was, but their stocks got beat up, but it confirmed exactly what the GDP report was saying. And so look, in a few days, Q2 comes out, July 28th. And look, estimates are going, it's going to be slightly positive. I think it's going to be negative. And when it comes in negative, you are going to read on your in your newspapers and everything else, oh, we're in recession. Okay. And oh my goodness, we're in recession. And then you'll start reading stuff like, well, the U.S. stopped defining recession as 2 quarters of negative GDP, and now they say a substantial slowdown in growth. Europe still says 2 quarters of GDP. The U.S. changed it like 3 years ago, and the way that they changed it to, there's no real definition. It's like, well, if there's 2 substantial quarters, like substantial, what's that? Like, it's like saying that's hot. Like, do you like spicy food? And you go, yeah. Oh, that's too spicy, right? It's like up for negotiation. So let's use 2 quarters of negative GDP. All right. So average recession. These are all the recessions since about 1910. The number that you see up here is the amount of months that those recessions last. Take all these numbers and average them out, you come out to about 11.8 months. Okay, come out to about 11.8 months. Q1 was obviously 3 months. Q2, I don't care even if we get a positive 0.3. I mean, it's close enough to negative to fit the definition. But what I was saying earlier is we're in recession, right? Well, average recession 11.8 months. Some are much shorter. And recessions have gotten much shorter, as we can see here. And my point being here is when you start to get the headline news of, hey, we're in recession, okay? You get a lot of people that freak out. But if I go back and I look at, the markets, technically when the announcement is made that we're in recession, it's like a baseball game. It's like, what inning are we in of this recession? Is really what you should be asking yourself. Hey, are we in inning one? We got 9 innings to go. Or are we in inning 6 or 7 or 8? And so typically speaking, when you get the announcement of recession, we've already been in recession for a while. And it's typically when you get markets that start to come back. And so what do I mean by markets coming back? And this is the concluding basically thing I'll say. Markets are selling off today because inflation. Inflation's at 9.1, wage growth is at 6.4. Therefore, the average consumer is taking a cut in pay. Therefore, they don't have as much money to spend on widgets, and therefore we don't sell as much ice cream and our company's worth less. Same thing with stocks. They go down in value. However, the question is, will that inflation cool? I showed you a bunch of data. I just report the news. Look, if the stuff in metals, if the stuff in agriculture, if gasoline, if all of that data was showing upwards, I would tell you, look, inflation's going to be sticky. At the same time, the Fed's been raising rates. If things go the way that we hope they go, the way that we said we see them going back in April, and now I'm showing you the data and that's actually happening, at some point, inflation cools, wage growth is sticky. You can't go to all your employees, hey, last year you made 100 grand, we just gave you a raise up to 107, and then all of a sudden say, just joking, we're bringing you back down to 100, right? So wage growth is sticky. So what we think will happen is all of a sudden you're going to start to see inflation come down. And you're going to see wage growth. Wage growth may flatten a little bit, but wage growth sticky. And the whole reason why markets are selling off today will reverse relatively quickly when those lines start to cross each other. It's always an elevator down with the stock market and a staircase back up. And the reason for the staircase back up is if we start to get that inflation that cools, okay, well, it's going to be like, well, it's going to continue to cool. Let's get the data for next month. Let's get the data for next month. And as that data, if it continues to stay positive, you will have a reversal of these two numbers combined with the Fed. Every month they come out and say something, saying something along the lines of our rising interest rate policy is now taking effect. We're seeing inflation start to cool. The market will love that. Now, let me caveat that by saying, if you go, oh, this guy's an idiot, right? You don't believe what I'm saying. I'm not saying that that's necessarily going to happen. Like I said, price of oil could go to 150 tomorrow. Food prices, the price of wheat could shoot up 100% tomorrow. What I am saying is I put together a presentation to show you the data of where it is today. Based upon that data, I'm making a conclusion. I don't know if that continues to happen, right? Russia nukes the Ukraine or something like that. You're going to see commodity prices shoot way up. Okay. And so, look, it's so funny. Every time when I show people this is a bull market. When markets are going up, my phone rings with people going, hey, I found an extra 100 grand sitting in my bank account. I think I want to invest it. Okay. When markets go down, people say, hey, you got to get me out, sell all this stuff. No, I will never invest money today. Are you kidding me? It'd be crazy to invest money. It's the funniest thing. And when I say it's the funniest thing, it's because it should be completely the opposite. When markets are up 20%, people should be calling me and saying, hey, sell. And when markets are down, people should be calling me saying, hey, I found an extra 100 grand in my bank account to invest. And when I say it's the funniest thing, when I have clients inside of the office and I show them a chart, such as a chart like this, they go, hey, that's pretty easy, Derek. I'm going to wait. Sorry, I should have put this at the end. I just want to use it as a visual. I'm probably giving everybody a headache because it's like one of the first charts on here. I'm going to wait until there's a big sell-off in the market, and I'm going to buy. And I go, well, that's a good idea, right? Because when markets are way down, if you thought about it, let's say for instance, I don't know, pick a year, right? So what was this? This was '09. So this was 2010. You had all your money and you bought when the S&P was down negative 28% in 2010. What did you do with your money? You did like a positive 41%. Why? Because even though the market was up 23, you bought when things were down 28. So when people see that, they go, "Oh, this is super easy." What I can tell you is only nobody does it. Nobody does it. And when I say nobody does it, I mean, there's nobody calling me today saying, "Hey, I want to put money into the market." But when I show them this chart, they're like, "That's when I want to do it." But when it's happening, nah, things are going to get worse. Back to that consumer confidence number, right? And back to that consumer confidence chart that I showed you, that's precisely when you see markets start to roar. And we will see markets do well if that inflationary number calms, which is what the data is showing us. Wage growth exceeds inflation. The exact opposite will happen in the markets. Listen, um, if you'd like these slides, again, please give us a jingle. We're happy to send you the slides. You will get the video presentation of what's been shown to you this evening. And also realize I am not a perpetual bull. People sometimes might say, "Derek, look, this is the business you're in. You have to be bullish. You have to say everything's okay." I am not. For those of you who were clients back in 08, 09, you probably remember around Dow 12,000, 11,000, we were going to 100% in cash or, heavily inside of cash. But what I can say is based upon the data that we're looking at today, and of course, we're looking at data like hawks today, it's coming in fast and furious. I am not particularly worried about where the market is. If commodity prices do shoot up, I will get worried very, very quickly. It's something we watch all the time. Again, nothing this evening should be taken as a recommendation to buy a security or buy into the markets. Although I may have painted a bullish picture and I painted a bearish picture, I would still say to you, there's no recommendations, right? Investments are meant to be long-term. Investments do well over the long run. I hope you catch my drift inside of there. And so on and so forth. So listen, this is the economic data that I presented to you tonight. Contact information is on the screen. Again, if you would like the slides, you can request them. You will get this video sent out to you. Obviously, as I always do, went way over. I think this was scheduled for an hour, and we're at an hour and 31. But as you can see, we are done. Hopefully, this sheds some light on things. I know it doesn't make people feel better about where the markets are. For many of our clients, we have 15 to 25% inside of cash. We've been like that basically for the first half of the year. We've been putting that cash back to work, and that is again buy low, sell high, right? Everyone thinks it's easy. Nobody wants to do it. Warren Buffett said it best: be greedy when others are fearful, and fearful when others are greedy. It's just a really creative way to say buy low, sell high. That's what you need to do. If you're an investor, I shouldn't say that's what you need to do. You should check with somebody, do the things you need to do to take that recommendation. That's just, what I'm saying. Everybody's advice is a little bit different. Anyways, thank you so much for joining, and have a wonderful evening. For now, I'm signing off, and I will see you all in the future. Thanks again. Bye-bye.